Hey there, online sellers. You know how GST can sometimes feel like you're trying to solve a puzzle in the dark, right? Well, what if I told you that a few tiny, common slip-ups in that puzzle are actually costing you cold, hard cash? Today, we're going to shine a light on those pitfalls and flip the script, so your GST filing starts working for you, not against you.
So let me ask you straight up. Is your GST filing actually costing you money? I mean, really think about it. It's so easy to think you've got it all under control, but even the smallest, most innocent-looking mistakes can snowball into penalties, missed credits, and a whole lot of stress you just don't need.
But hey, that's exactly why you're here, right? We're about to break down the top 10 most common and, most costly errors that trip up online sellers just like you. Stick with me, and by the end of this, you'll have a crystal clear guide to filing with absolute confidence.
All right, first things first. We're starting with the absolute bedrock of your GST, reporting your sales. This is ground zero, and it's where some of the biggest, most fundamental mistakes get made. Okay, mistake number one. This is a classic, and I see it all the time. You look at your bank statement, see the payout from your marketplace, and you report that number, right? Wrong. See, the marketplaces take their cut, their fees, shipping costs, that little thing called TCS, before that money ever lands in your account. But here's the kicker, the taxman wants GST on the full price your customer actually paid.
And this right here just lays it all out. Let's say a customer pays 10,000 rupees for your product. After all the deductions, maybe you only see 8,500. It's so tempting to just report what you received, but that's the mistake. You have to report the full gross value of 10,000. So what's the golden rule here? Simple. Always go to your marketplace's gross sales report. That's your source of truth for GST.
All right, next up is mistake number two, messing up the type of tax you apply. It's all about location. If you're selling to someone in your own state, you charge two taxes, CGST and SGST. But if you're selling to a customer in another state, that's just one tax, IGST. Sounds simple, but you'd be surprised how often this gets mixed up. So check out this example. Let's say you're based in Rajasthan and you get an order from someone in Maharashtra. That's a classic interstate sale. You absolutely have to charge IGST on that bill. If you accidentally charge CGST and SGST, you're going to have a compliance headache later. The bottom line is super simple. It's not about where you are, it's about where your customer is. Returns. The joy of e-commerce, right? We all deal with them. But here's the thing. If a customer returns an item and you don't properly account for it in your GST filing, you've basically just paid tax on a sale that never really happened. You paid tax on money you had to give back. You've got to claim that tax back.
So what's the right way to handle it? Well, just ignoring it is definitely the wrong way. The correct official procedure is to issue something called a credit note and then report that note in your GSTR1 filing. That's how you tell the government, hey, this sale was reversed. It reduces your total sales number, and most importantly, make sure you're not paying tax on ghost sales.
Okay, so we've covered the money going out for taxes. Now, let's get to the fun part, getting some of that money back in the form of tax credits. This is part two, and trust me, this is where a lot of sellers are unknowingly just leaving free money on the table.
Now, this next one is a huge deal. It's called Input Tax Credit, or ITC. Think about all the stuff you buy for your business, packaging materials, marketing services, whatever. You paid GST on that, right? That GST is your credit. But here's the crucial mistake. You can't just claim it because you have an invoice in your hand. Nope. That credit has to show up in your GSTR 2B form on the GST portal first. And this is exactly what I'm talking about. The old way was just using your purchase invoice. The new, correct way is waiting for it to appear in your GSTR 2B. Why? Because that GSTR 2B is the government's official record. It only shows up there after your supplier has done their part and filed their taxes. So the rule is simple. If it's not in GSTR 2B, you can't claim it, period. Always check that form first. Hey, remember that TCS we talked about earlier? The little bit of tax the marketplace collects on every sale? Well, that money doesn't just disappear into thin air. It gets deposited into your account on the GST portal in something called the electronic cash ledger. It's literally your money, sitting there waiting for you to use it to pay your taxes. It's like finding money in your pocket, but you won't believe how many sellers just forget it's even there.
Okay, let's dive into something a little more advanced, the reverse charge mechanism, or RCM. It sounds complicated, but the idea is simple. For some services, think legal advice or services from an unregistered person, the roles are flipped. Instead of the supplier paying GST, you, the buyer, have to pay it directly to the government. And the number one mistake people make? They try to claim the credit for it before they've even paid the tax.
You absolutely have to think of this as a two-step dance. Step 1, you take the tax amount, say it's 18,000 rupees, and you pay it to the government from your own cash. Step 2, then and only then can you turn around and claim that same 18,000 rupees back as an input tax credit. It's a loop. You have to pay it out before you can claim it back in.
All right, we're heading into the home stretch. Part 3 is all about what I call the fatal filing errors. These are the procedural slip-ups that aren't just about losing a bit of money. These are the mistakes that can get you a notice from the tax department and cause some major league headaches.
This one is non-negotiable. You have two main returns. GSTR1, which is the detailed list of every single sale you made. And then there's GSTR3B, which is the summary you use to actually pay your tax. These two reports need to be identical twins. The numbers have to match perfectly, down to the very last pay.
And let me be crystal clear about this. A mismatch between your GSTR1 and GSTR3B is basically like sending the GST department a personal invitation to send you a notice. It's a huge red flag for their automated systems. So please, before you hit that submit button, double-check and triple-check that these two forms are in perfect sync.
Look, we're all human. Sometimes you file late. It happens. But here's the trap. You can't just pay the tax you owe and call it a day. The system automatically taxes on late fees and interest for every single day you're delayed. And yeah, you have to pay those too.
And believe me, those fees are no joke. They add up shockingly fast. We're talking 200 rupees a day in late fees. That's 100 for CGST and another 100 for SGST. It can quickly turn a minor oversight into a major expense. The cheapest way to file your taxes? On time. Always.
And for our last big mistake, please remember that selling online is a different ballgame from running a brick-and-mortar store. There are specific rules for e-commerce, and this one is the most important. For offline businesses, there's a turnover limit before you need to register for GST. For online sellers, that limit is 0. From your very first sale, your very first rupee, you need a GST registration. There are no exceptions to this rule.
Whew! Okay, I know that was a ton of information, but don't worry, we're going to wrap this all up with a simple, powerful tool you can use every single time you file. Let's put it all together in your new error-free checklist.
This is it. This is your game plan. Let's run through it. 1. Match your sales to the gross marketplace reports. 2. Reconcile with GSTR2B before you claim any ITC. 3. Claim that TCS credit. It's your money. 4. Always check the customer's state to apply the right tax. 5. Track every single return and issue a credit note. 6. Follow the two-step pay then claim rule for RCM. 7. Make sure GSTR1 and 3B are perfect matches. And finally, use the correct HSN code and GST rate for your products. Got it?
And that really brings us to the big picture, doesn't it? You've poured your heart and soul into creating an amazing product and a beautiful storefront that customers love. So the question I want to leave you with is this. Are your finances as professional as your storefront? Nailing your GST is a massive, massive step in making sure the answer to that question is a resounding yes.